So today we're discussing the classification here, and there's a bit of a debate. I want to set the background first. So we're talking about MSCI including DATs into their global investable market index or not, and they've been doing consultation to end of this month. The magic number seems to be 50%. So if the operating activities hold more than 50% of the digital assets, is classified as a fund, or whether it's going to be included in the index or not. So today I would love to start with the first question. I mean, are DATs truly operating companies, or are they funds? So what do you think about the classification, and how do you, I guess, justify it?
I think that DATs need to be operating companies. I think that what happened was that there was a pent-up demand for capital markets to enter into the crypto space. So all of a sudden, all of these companies were able to come into the space at the same time, and everybody jumped on the bandwagon, and a lot of DATs got created. And like Atsu was saying, it's very difficult to operate a public company versus just being a crypto company. So I think that all of these DATs are now trying to figure out how to create operating businesses inside of their DAT so that they can not only generate revenue, but they can have growth beyond just the yield of staking tokens. So I think that's the most important piece inside of these DATs, and the next iteration of DATs that will happen will be operating businesses that are focused on something beyond just holding a token and have a real business inside of them.
Yeah, I agree with Christopher. This DATS wave that happened in the last year reminds me a lot of the 2017 ICO boom. We had a company, which is MicroStrategy or Strategy, that found a good business model, and then everyone started coming in and creating their own DATs, and then we had some not great performances as of now, and of course, it starts creating a couple questioning about it. So, of course, regulators, investors that got somehow affected by the discounts that happened start questioning. And, of course, it is a valid question that the MC is bringing up. But, in my opinion, they're still operating companies. It's just a part of their company is holding and dealing with digital assets, not just Bitcoin or Ethereum. It could be, tokenized assets and other types of real-world assets, for example. So we cannot just think that it's about tokens like BTC, Ethereum, or all of these other tokens that created their own DATs. But yeah, they're still operating companies, and Michael Saylor has pointed out in a quite aggressive message as well that he does not think that DATs are funds.
Yeah, I agree. Most DATs do have operating companies. So MSCI has an AI software business that generates about $500 million a year in revenue. But that's about less than 1% of their total DAT portfolio. So they have about $60 billion of Bitcoin. So their total assets, or their digital assets, exceed more than 50% of their total assets. And that's the issue that MSCI has, that DATs with more than 50% of their assets and digital assets could be excluded. So it would be a pretty big event. MSCI has about $15 to $20 trillion of assets benchmarked on the indices, and many sovereigns and pension funds track the MSCI indices. So they allocate a basket of their portfolios towards stocks on this index. So it would be pretty bad. JP Morgan expects about $2.8 billion of selling pressure just for Strategy if it gets delisted. And that's about 5% of its total market cap. So it would be pretty bad. I don't know if it will go through or not. If it does go through, it would be pretty bearish in the short term. But zooming out to the long term, there were only 38 DATs on the list that could be delisted. And if you look, there's about 200 companies globally that hold digital assets it's still a small fraction of the global pie. There's about 4,000 public companies in the US and about 50 to 100,000 public companies globally. So I still think we're very early. I think many corporations will acquire Bitcoin, and there'll be more companies that own less than 50% of their assets in digital assets than more than 50%. So it's a small section. I do think MicroStrategy should be allowed to hold more of their assets in digital assets, but if it goes through, I don't think it will be the end of the world.
Yeah, I think that's a really excellent point because it's never binary. It is a spectrum. And within this spectrum, there are different strategies getting deployed in DATs as well. But this classification surely would impact how investors would look at DATs and their expectations. So the next question following up is, how much is too much? We talked about 50%, and it's a very, I would say, simplified cut. So I wanted to get your view on, what do you think is the right threshold? When do you think it gets into structured products versus operating companies?
So inside public companies, there's a rule that if you own more than 40% of a security, you become an Investment Act company. So digital assets are excluded from this because of the nature of what they are. But if you owned, if your company as a public company owned 80% of a particular security in another company, you would have to become an Investment Act company right away. So I think what the regulators are doing are looking at this and saying, why are these companies not Investment Act companies? And why do they get a benefit for doing this? Just because they are, just because they are a digital asset. And I think that the operating side of the business is very important because if you just have the asset inside the public company, then you're just focused on getting yield off of the token in some way. And that's just not enough. It's not enough to grow at 5% a year or 7% a year. The opportunity has to be more significant than that. Like you have all of these DATs that started that were the big ones, the MicroStrategy, the BMNR, all of the big guys that started, then all of a sudden there's all these other ones that he was referencing earlier that are smaller, and all of these smaller ones need to show some form of operating business inside their business. So I think that everybody's focused on that and trying to figure out how to accomplish that, and I think that's the most important element for what's going on in the DATs today.
And for the other panelists, I would like to hear, what do you think other metrics can come into this as well, not just 50%?
Can you repeat the question?
So if there's any other metrics you think are worthwhile considering than just a simplified 50% holding cuts, that would be great.
I mean, as Christopher was mentioning, I think besides holding the assets, you could use them in different ways, right? From running validators, creating strategic deals like Yatsu was mentioning with AlphaTone and one of his ecosystem projects. Just a simple cut of 50% might be a bit, how can I say, not as relevant for the digital asset space, given that we can, and we are a creative industry trying to find ways to, generate yield in different aspects. So it could be interesting to look into other factors besides just this cut of 50%. But yeah.
Yeah, I think the 50% it is quite a good one, but I think more systematically, I think leverage could kill the industry, or at least in the short term. That if these companies have too much leverage or too much debt, that they maybe become forced to repay or forced to sell their Bitcoin. I think that's more systemic. So looking at the leverage ratios could be more interesting.
But if they do get what you're calling delisted, right? But that's not delisted from NASDAQ. It's just delisted from the index itself. That wouldn't cause them to sell the Bitcoin. It would just cause the stock to be sold, which it would actually be a good buying opportunity for the people that are in this room that understand what's going on, I think,
Just recently MSDR mentioned that if their MNAV falls below 1x, they may be forced to sell Bitcoin to buy back shares. So it could cause selling of Bitcoin.
I think this point was touched upon slightly. So does the intent matter? Like the idea of this DAT, the purpose of it, is it going to be strategic reserve or is it going to be used as investment purposes? Like it's very hard to index rule the intent, of course, but what's your view on this? Does the purpose of the DAT matter that much when it comes to classification and index inclusion?
I'd say there'll be more companies that diversify their treasuries, that just hold less than 50% of their assets in digital assets, because then you have 4,000 public companies in the US, 50 to 100,000 globally. So there'll be a larger percentage that just hold some Bitcoin.
I think that the classification of the DAT itself as an operating business is the most important thing. So like the one that we just did for Aether, we raised $350 million for the DAT, but the business itself will this year, hopefully, based on what we're doing, generate $100 million in revenue outside of the DAT because of the operating business itself that's going on renting GPUs and providing infrastructure GPUs. So the DAT will start to get a multiple of other GPU providers, which are trading at somewhere between 10 and 65 times sales, which is way more favorable than a one-time MNAV or a discount to MNAV. So I think that if the company can illustrate that they can grow the top line beyond just the staking yield or generating yield off of doing market making or whatever you're doing in with the tokens, then I think the opportunity for the value of the underlying public company and the market cap of the underlying public company can grow exponentially.
I agree. I think that's such a good point because, yes, companies that are already included in MSCI, GRMI index, they hold gold, they hold FX, they hold a lot of stuff on their balance sheet anyway, but they are never called a fund or being excluded. So when it comes to digital assets, I see the point that MSCI is trying to make, which is they do not want just pure investment fund to get included in the index. It's the base rule itself. The index is supposed to be tracking the real economy. So the idea here, which is the next question, is why they're so strict on digital assets? Do you think that reflects the discomfort of TradFi when it comes to crypto? Do you think this is justified? Do you think we're getting penalized for the innovation? How do you feel about this?
I mean, there's two ways to look into, right? It depends on each other's perception about the crypto market itself. You could say that, no, we're not being penalized. Digital assets are still such a small market compared to traditional finance, and that is just the curse of the matters of trying to regulate different markets and understanding the digital innovation happening in the space. But of course, there is the second option of, yes, they're trying to penalize, given that crypto is becoming slowly every year more relevant, and that it could potentially in the future somehow disrupt the traditional finance industry. But yeah, there's those two views. I guess it depends a lot on what is your belief in crypto and how do you think it will affect the traditional market in the future or not.
Yeah, I think on one hand they could be, seriously think it's a risk to their index, or they could be playing some regulatory arbitrage where they have competing products like ETF products. MSCI is owned by Morgan Stanley, so it could be Morgan Stanley wanting to offer different types of products and have less competition. JP Morgan as well, who wrote some reports on this, they're also offering some products as well. So it could be they're trying to reduce competition.
There are some shareholder issues happening.
I think that I've been, in my entire career, I've always been involved in public companies. Since the first company that I ever started, I sold my first company to a public company when I was like 23 years old. And then ever since then, I've been involved in public companies. and I've lived through this life of, different public entities and what it's like to be inside of a public company. And I think that I couldn't agree more with what Yat said earlier. Like, everybody needs to be prepared for what it's going to take to run the public company once they get in there. But these public companies would never be able to raise $300, $400, $500 million, even if you exclude the in-kind contributions that are happening, the 50, the $100 million into a small cap company. It's just unheard of. They'd end up doing deals with structured financing companies that have ratcheted financing deals, that are resets and warrants and all kinds of stuff like that is not in the narrative that we're seeing now inside DATs. So yes, it's very valuable that the digital assets are able to come into the space. And I think that those companies they're not seeing a discount, they're seeing a premium because of the value people are putting on the future of this space.
Yes, and also to be honest, DATs are not punished for holding Bitcoin. DATs are just challenged to show that they're more than just a BTC wrapper. I think that's the core of it. You touched upon the fundraising side. I wanted to ask, how do you think DATs can help attract more legitimacy and investor confidence? Because it was mentioned in the previous panel as well, telling the story and continuously demonstrating what you're doing and what you plan to do is very important, and getting investor on board. That's one of the advantage that has as well.
I think that, for the companies that went out first, it was very easy because the market was just chasing the deals. So it's very easy for all the first DATs that came out to go out and raise capital. But if you go back and look at the banks that have done deals since those first DATs came out, they actually haven't raised that much money on top of the in-kind contributions that have been coming in. So like in the DAT that we just finished up, we raised $350 million. The bank that we worked with only raised $6 million of the $350 million. We ended up raising the rest of the money on our own, but you have to bring in the bank to get in the process. So I think what's happening now, and in talking to all of the investors that are investing in these transactions, they're switching their mindset back from chasing the deals and trying to invest in something that's going to see a pop and be able to exit, to structuring financing deals. You're seeing a lot more transactions that are coming in as convertible notes, that are coming in as secured by the underlying asset itself. So I think that the story about what happened this year is not going to be what's going to happen next year on the capital raise side. You're not just going to walk in and say, we're selling this much equity at this level, jump on board, because everybody, if you look at the portfolios of the asset managers that have invested in these things, if it wasn't for Upexi and the first ones that came out, they would be very down for the year. So I think that that's going to change the approach that all of these traditional finance people are doing, and they're going to go back to their model. Like, these investors that are investing outside of the crypto space, they don't even care sometimes what they're investing in. They just want to make sure that they can make money on the way out. And they're looking at how many shares are in the market, how quickly can they exit, and it's a just completely different mindset. And I think that will come into play this year much more significantly. And I think you're going to see a lot more warrants. You're going to see a lot more additional things. You even saw it at the end of this year. So a lot of deals that added warrants just to get them closed.
I think the DAT movement brought a bit of more seriousness into the crypto market. We have banker friends that were pitched, and they mentioned to us some crazy stories of founders that joined the calls or the meetings. They were completely not prepared. They did not have just overall respect towards those traditional finance bankers, and it really was, I guess, a wake-up call to a lot of these crypto firms that wanted to jump into the wave and were like, okay, if everyone is fundraising, I can do the same. And then when they experience it, they're like, oh, actually it's not as simple. The traditional finance, it is a much more developed and complex market. It's not just how we see in crypto of let's meet at a conference, let's just discuss, maybe have a dinner together and then close the deal. So yeah, I think it was a good wake-up call for us to kind of prepare ourselves for the future. If we are really willing to bring in the institutions, we should also act accordingly. So yeah, I think it was somehow positive, this big wave. But of course, now we will see who will actually execute properly or not, given their teams that they're building or who are running actually those DATs.
I would add that some of the more successful DATs, so if you look at Michael Saylor and Tom Lee, they're great communicators, they're very efficient, and they have long-term vision. On the communication, you want the DAT team and CEO to be on TV a lot, ideally, and to be speaking to investors, doing investor roundtables, and just very available to all stakeholders. They shouldn't be hiding or avoiding. So the communication needs to be very strong. You also need to be very efficient. You need to have appropriate compensation structures. We recently saw ProCrap adjust their compensation so that it's not all cash-based, that it's tied to performance milestones, and that it's majority equity-based. I think we'll see more equity-based compensation, and so you won't have big cash salaries and spending on private jets or things like that. So we'll see more efficiency in the successful DATs, that they're able to pay for their expense through their income, and that they're profitable, cash flow positive, and that they're building efficient companies. Also, one other metric for this is their dashboard. They should have very transparent dashboards that should go up very quickly after the raise. And I'd say finally on the long-term vision, it's not a short to medium term, it's a long term. How can they build multi-decade generational companies?
Excellent. And from this panel, I think that was such great points being brought up. My K-learning here, if DAT survives this market and going to next year, Feb, the index inclusion, what it would look like, operating models, sustainable operating models. And number 2 is institutional grade risk and reporting that being mentioned. Number 3 is the regulation and index inclusion. Let's hope for the February next year to have another great decision from MSCI. But yeah, thank you very much.
Thank you.
Thank you.